So Repay Holdings just put out their Q3 numbers. And honestly, at first glance, they look fine. But the stock, it's been absolutely hammered this past year. So what's the real story here? We're going to dig in and figure out if this is a turnaround you want to get in on or a trap you need to avoid.
All right, so here's the big question, right? The numbers were basically in line, so why is the stock down almost 60%? To figure this out, we're going to break it down. We'll look at the actual numbers, what management is trying to tell us, what the market is really worried about, and then we'll give you our take on what happens next.
Okay, first things first, let's just look at the print. And right away you can see it's a bit of a mixed bag.
So, as you can see here, revenue was right on the money. Same with adjusted EPS, smack dab in the middle of what Wall Street was expecting. But then you look at the GAAP number, the official by-the-book earnings, and ouch, a pretty big miss. That right there is our first clue that something's not quite right under the hood.
So even with that GAAP miss, management got on the earnings call and tried to spin a pretty positive story. Their whole theme was normalized growth, basically getting back to basics. And listen to the CEO's quote here. The word you've got to zero in on is normalized. What they're really saying is, hey, forget about some of the one-off stuff like the political cycle last year. Look at the core business. That's what's healthy. They're trying to reframe the narrative.
And here's the evidence they're using to back that up. This is the highlight reel they want you to focus on. They're pointing to that 5% normalized growth, and especially that 12% jump in their B2B segment. They're talking up new AI tech, new partnerships, and look at that supplier network, up a whopping 60% year over year. This is the bull case they're laying out for everyone.
Okay, so if management's story sounds so good, why is the market so freaked out? Why is the stock getting crushed? Well, it all comes down to one really big problem. And that problem is margin pressure. In simple terms, they're making less money on every dollar of business they do. But the real kicker, the thing that sent a chill down Wall Street's spine, was when management admitted these issues are structural and will probably persist. You hear words like that on an earnings call, and alarm bells start ringing. Big time.
This slide just lays out the conflict perfectly. On one side, you have management's story, look at our growth, look at our new clients. But on the other side, you have the market's concern. Yeah, but your gross margins just dropped over 3%. And it's happening because they're paying higher fees and signing bigger clients that just aren't as profitable. So the fear is, yeah, you're growing, but it's low-quality growth.
And if you want to see what that fear looks like in dollar terms, here it is. It's pretty brutal. While the overall market is up nicely, Repay is down almost 60%. This isn't just a small dip. This is the market screaming that it does not believe the turnaround story, at least not yet.
So what's management doing about all this? Well, they're not just sitting on their hands. They have a very clear defensive game plan in action.
It's basically a three-step playbook. Step 1, clean up the balance sheet. They're paying down a big chunk of their debt. Step 2, buy back their own stock. I mean, it's cheap, so they're scooping it up and have already taken about 8% of the shares off the market. And step 3, just keep a strong cash position. It's all about de-risking the company.
All right, so we've seen the numbers, we've heard both sides of the story, and we know management's game plan. Now it's time for our take. Let's talk about what we think happens next and what our official rating is.
So looking ahead to Q4, management is guiding for 6 to 8% normalized gross profit growth. And that sounds okay, but you have to know that's at the very low end of what they were saying before. It's a subtle way of telling us, yep, those margin headwinds we talked about, they're still here.
So here's our prediction for the next quarter. We think they'll land right around 6.5%, hitting the low end of their own guidance. For free cash flow, we're penciling in about 58%. And we're not just pulling that number out of thin air. The CFO pretty much told us to expect an upper 50s rate. What does this mean for the stock? We think it's stuck. It'll probably trade in a tight range until we get the full outlook for 2026. The market is in full wait-and-see mode.
So you might be wondering, what's stopping the stock from just collapsing? What's the floor here? Well, it's this number. 2.5x net leverage. It's manageable. As long as they keep their debt in check like this, the balance sheet should provide a pretty solid floor and prevent a freefall.
And all of this brings us to our final rating, market perform. Look, the company is in a tough spot, a transition phase. The good stuff, the buybacks, paying down debt, that should put a floor under the stock. But the bad stuff, those structural margin problems, is going to put a ceiling on it. There's just not much upside until they can fix the core profitability. It's a classic prove-it story.
But that doesn't mean there isn't an interesting trade here. If you look at their 2026 convertible notes, that's debt that can turn into stock, management is making it a huge priority to buy them back. So a potential idea could be to go long the notes, since the company itself is a big buyer, and short the stock. That way, you're betting on the balance sheet getting stronger while hedging yourself against the core business staying weak.
And as always, this is not financial advice.